On July 2nd, the gold market delivered what I can only describe as well. It was the financial equivalent of a horror movie jump scare.
Oh, that is the perfect way to put it. Absolutely.
You are watching the charts, the tension has been building up for weeks, the price action is just creeping down this dark hallway, and then bam, out of nowhere, massive volatility hits the tape.
It was a very violent move, caught a lot of people completely off guard.
I mean, absolute whiplash for anyone with skin in the precious metals game. We are talking about gold plunging down to stare into the abyss at $3,960 an ounce, only to violently reverse course and surge nearly $150 in just a matter of hours, hitting $4,110.
Yeah, the sheer velocity of that was incredible.
It really was.
Right then, welcome back to the deep dive. Before we get straight into it, do make sure you hit that like button, subscribe to the channel, and drop a comment down below with your thoughts as we go. We really want to hear your take on this. Joining us today to make sense of the madness is senior market analyst Dr. Khalid Al-Nuaimi. We are looking at a market that has, quite frankly, just stopped behaving like a physical commodity. It's July 2nd, 2026, and today's mission is to unpack a massive stack of market reports and strategic updates on gold and silver. Okay, let's unpack this. How does a miss of just 20,000 jobs in an economy of 330 million people instantly move a trillion-dollar asset class by $150 an ounce?
Well, yeah, it sounds absurd when you put it like that, but what we're looking at right now is it's basically the definition of muddy waters. Because in this world of pure information overload, navigating this volatility, it's not about just reading the raw numbers on a screen.
No, of course not.
Right. It requires connecting dots. You have to understand the underlying mechanics of market psychology, these institutional algorithms, and global liquidity.
And we really need to talk about the sheer scale of what just happened. Because for everyone listening right now, you need to grasp the magnitude of this price action. I mean, we just wrapped up the second quarter of 2026. And for gold, it was the worst second quarter we've seen in 13 years.
Yeah, since 2013. It's been a brutal bleed.
A completely brutal bleed. The sentiment was just incredibly bleak. Gold plunged all the way down to $3,960 an ounce. And then out of nowhere, the market experienced this violent reversal. In just a few hours, gold shot up nearly $150 to around $4,110 an ounce.
Which is staggering. And silver mirrored that exact same chaos. It dropped to $57.30 an ounce, skyrocketed up to $61, and is settled near $59.50 right now.
Even the other metals got pulled up, right?
Exactly. Platinum and palladium were caught in that updraft too. And gold itself is hovering around $4,050 at the moment.
Spot on. But look, when I see a sudden massive vertical spike like that after months of losing, I don't necessarily see a real recovery. It feels more like a rubber band that was stretched way too far down and just snapped back. Is this an actual recovery, or is it just a dead cat bounce from exhausted sellers?
What's fascinating here is that the data points much more toward a technical bounce. It's not a confirmed trend reversal yet. I mean, capital did flow back into precious metals, sure, but we have to look at where gold actually stalled out during that run.
Right, because it hit a ceiling. The reports mentioned a very specific resistance band sitting right between $4,100 and $4,120 an ounce.
Yeah, and during that $150 spike, gold slammed right into that exact ceiling and immediately retreated. A real structural recovery needs organic buying pressure over days, not just hours.
So it was just a flash flood of cash coming in to close out short positions.
Precisely. Once those people betting against gold covered their positions, the buying vanished. And gravity just took over again.
So we need to look at that gravity keeping gold down. These reports outline a formidable wall of macroeconomic headwinds. And the first two are really tied together. We've got a super strong U.S. dollar and high U.S. Treasury yields.
Yeah, those are the big ones.
The DXY index, which tracks the dollar against other major currencies, is sitting really high, over 101.4, and the 10-year Treasury yield is hovering around 4.48%.
Which is the primary engine driving this whole market right now. You have to remember, gold is priced globally in U.S. dollars. So when the DXY is that high, the dollar is incredibly strong compared to the euro or the yen.
Meaning if you're an investor in Europe, gold just became way more expensive in your own currency.
Exactly. It automatically destroys a whole layer of global physical demand.
And then you've got that 10-year Treasury yield at 4.48%. I mean, holding gold right now, it feels a bit like owning a beautiful classic car, right?
How do you mean?
Well, it looks great sitting in the garage, but it doesn't pay you any dividends. It actually costs you money to store and insure it, whereas a high-yield savings account or a treasury bond, that pays you nearly 4.5% just for parking your money there.
That's a great analogy. That opportunity cost is the invisible hand pushing gold down. But wait, We also have to look at the massive structural shifts in the physical markets. The reports highlight some severe hits to demand in Asia.
Oh yeah, the India and China situations.
Right. India just raised its import tax on gold. And historically, they are one of the biggest consumer markets in the world for jewelry and cultural demand.
So making it more expensive just kills that retail demand. But the move by China actually seems even more damaging to the market structure itself. They completely restricted their commercial banks from trading gold to stop domestic speculation.
Which is vital to understand. Because commercial banks in China aren't just trading for themselves, they act as the primary market makers.
Right, they provide the actual liquidity on the order books.
Exactly. They allow massive institutions to buy and sell without moving the price too wildly. So when the Chinese government stripped those banks out of the equation,
They basically removed the market's shock absorbers.
yes, they hollowed out the order books. That's why a sudden rush of buying could cause a $150 spike in just hours. There were no banks there to absorb the trades, so the price just gaps higher and higher into a vacuum.
Wow. Okay, so when order books are that thin, volatility just explodes. Which brings us to the actual spark that caused that explosion yesterday. We had 3 data points hit almost simultaneously.
Yeah, a real perfect storm.
First, the ADP private employment report. The market expected the U.S. economy to add 118,000 new private sector jobs, but it only delivered 98,000. Second, U.S. Federal Reserve Chair Kevin Warsh was speaking over at an ECB forum in Sintra, Portugal.
Right, and he finally admitted that inflation pressures have eased up a bit, even though that 2% target is still firmly in place.
And the third factor was oil. WTI crude dropped to around $67.70. Brent fell to $70.80. And the reports link this to U.S.-Iran talks about maritime safety and the Strait of Hormuz. Less tension means less fear of supply chain disruption. But look, here's where it gets really interesting. It is completely ironic to me that a miss of 20,000 jobs, which is bad news for the U.S. economy, was the trigger for a massive gold rally.
It is ironic, but to understand why a tiny 20,000 job miss matters to a trillion-dollar asset, we have to talk about how modern markets actually function.
Okay, wait on us.
Well, the high-frequency trading algorithms that control these short-term moves, they do not care about the health of the everyday economy. They only care about one thing: the Federal Reserve's interest rate path.
Because for months, the data has been too hot, keeping rates high.
Right. So when that ADP report prints at 98,000 instead of 118,000, those algorithms aren't seeing 20,000 unemployed people. They are reading a binary, computerized signal that the U.S. economy is finally cracking under high interest rates.
And if the economy cracks, the Fed has to cut rates.
Exactly. The computers see the weak jobs number, calculate a higher probability of a rate cut, which means the dollar will weaken and bond yields will drop.
And since a weaker dollar and lower yields are exactly what gold needs to rise, the algorithms just instantly execute massive buy orders.
Instantaneously. Add in the lower oil prices taking the edge off future inflation fears, and the algorithms have a flashing green light. And because China drained the liquidity, those buy orders slammed into a hollow order book, causing the price to just gap up $150.
So it wasn't even human beings deciding gold was a good value. It was literally just code executing a probability matrix.
Pretty much, yeah. And that algorithmic dominance perfectly frames the massive tension we have heading into the biggest event of the week, because ADP was just the private estimate.
Right, the official U.S. non-farm payrolls report. The sources make it clear this is the ultimate showdown. If the official jobs data comes in weak, proving the ADP number was right, gold could blast right through that $4,120 ceiling.
Traders would immediately price in an imminent rate cut.
But if the official jobs data is strong, gold could get hammered right back down below $4,000. It's like the non-farm payrolls report is the final boss of a video game that investors have to beat this week.
That's a brilliant way to put it. It acts as the interest rate thermostat for the entire global economy.
But wait, this is what I don't get. If we step back and look at the long-term fundamentals in these reports, they are incredibly strong. We've got massive geopolitical instability, ballooning U.S. public debt, and global de-dollarization led by the BRICS nations. So why should we care at all about one single monthly jobs report?
Well, if we connect this to the bigger picture, it explains the disconnect. The long-term case is built on those tectonic geopolitical shifts you mentioned. Central banks around the world are hoarding physical gold at record paces right now.
Yeah, the reports really hammered that point home. Why are they hoarding so much?
Because of that de-dollarization trend. If BRICS countries want to trade outside the U.S. dollar system, they start settling in local currencies like the yuan or the rupee.
But that creates trade imbalances, right?
Right. One country ends up holding a massive pile of another country's fiat currency. which they might not fully trust long-term. So they need a neutral reserve asset to balance the books. That's why central banks are aggressively hoarding gold. It has no counterparty risk.
So we have a total clash of time horizons here.
Exactly. Central banks are operating on a 10 to 20-year timeline. They don't care about a 20,000 job miss in a monthly U.S. report.
But the hedge funds and the algorithms setting the price today are operating on a 10-minute timeline. They're surfing the immediate waves of Fed policy while central banks are basically buying the ocean underneath them.
That's spot on, which is why the investment strategies outlined in these reports are so sharply divided. For short-term traders, the mandate is extreme caution. Do not chase these violent rallies.
Because the human impulse is FOMO, right? You see it shoot up $150 and you want to buy the breakout.
And the reports explicitly say, don't do that. Wait for sharp dips to buy if you're trying to trade the short-term range. But the warning for long-term accumulators is even more crucial.
Yeah, they strongly caution against panic selling at these lower levels. And they specifically cite the massive bid-ask spreads. Because when volatility explodes, the market makers widen the gap between the price they'll buy from you and sell to you just to protect themselves from getting run over by the algorithms.
And that protective mechanism completely punishes the retail investor.
Yeah.
If you let a sudden price drop panic you into selling your physical gold today, you are getting a terrible discounted price on the way out.
And if the jobs report comes in weak tomorrow, the market bounces and you want back in.
You pay a massive premium on the way back in. They gouge you in both directions.
Brutal. So if short-term traders should wait and selling is structurally punitive, the advice for long-term holders is essentially to put on noise-canceling headphones. Just ignore Kevin Warsh in Portugal, ignore the jobs report, and stick to a blind schedule.
The reports recommend strict dollar cost averaging for exactly that reason, just buying a set amount periodically.
Even though it's psychologically painful to buy when the screen is bleeding red?
Oh, it's incredibly difficult. But it removes emotion. You stop trying to outsmart a supercomputer parsing data in milliseconds. The fatal risk here isn't buying right before a dip. The real risk is emotional capitulation.
Letting a temporary algorithmic swing scare you out of a long-term position.
Exactly. If you believe the macroeconomic foundation is sound, the daily weather shouldn't dictate whether you stay in the house.
Fair enough. So what does this all mean? Pulling the threads together, we have a market caught in a massive macro tug-of-war. A strong U.S. dollar and 4.48% yields are pulling capital away, while computerized anticipation of a slowing economy is just waiting for an excuse to price in rate cuts.
And it's all trapped in a market with hollowed-out liquidity.
Right. So for you listening right now, the takeaway is to understand these mechanics. When gold moves $150 in an afternoon, it's rarely a shift in the metal's fundamental value. It's algorithms reacting to monetary policy. Don't let short-term volatility panic you.
And, there's a broader systemic implication here that I think is worth pondering.
Let's hear it.
We just saw how a single private payroll report missing by a mere 20,000 jobs triggered a cascade of algorithmic buying that moved a $1 trillion asset class by $150 an hour.
It's an absurd ratio of cause and effect.
It really is.
Yeah.
And it forces a profound question. If a rounding error in a single data set can spark that level of instantaneous violent capital reallocation, just how fragile is the broader financial system?
Oh, yeah.
Has our modern economy become dangerously over-optimized around these microscopic data releases to the point where the actual health of the economy is completely secondary to the algorithms trading its shadow?
That is definitely something to keep in mind the next time the market tells you the sky is falling. It might literally just be a supercomputer reacting to a rounding error. Right then, that is all we have time for today. Thank you so much for joining us on this deep dive. Don't forget to like the video, subscribe to the channel, and let us know your thoughts in the comments. We'll catch you in the next one.